Good morning. It's 9 o'clock. It's Richard Calhoun, real estate broker for 40 years in Silicon Valley with Creekside Realty, working with consumers buying and selling houses. We're here today to discuss the real estate market and basically what's happened in the last week. This slide is just some URLs that you've seen many times before. It's how you get the information if you want to look at it. Jumping right into it, days on sold inventory. That to me is the single biggest indicator of what the market's going to do. In a free economy, it's supply and demand. That's what days on sold inventory is. It's not necessarily whatever the inventory is or whatever the demand is. It's the ratio between the two. Because if they're both high, you still have a great marketplace. If they're both low, you still have a quick marketplace, but not a lot of activity. If inventory is really high and demand is really low, then you have a slow marketplace. So that's the concept behind supply and demand. And what we have here is the gold line. That's the 5-year median. That's 2015 through 19. On the left side of the first purple line is 2021. On the right side, all the way across, is 2020. And the second purple line is shelter in place. So you can see the blue line is the current data. It's exactly on top of the median data. So we're having a great year compared to the last 5 years. I would expect that to continue. I would not expect the blue line to go up. That was a shelter in place issue. So basically, I'd expect it to come along down here and then, follow the trend for the whole year. So that's what I'd expect. And just to put it in some concept, we're talking about DUI in the low 20s. That is just unheard of. That means we'd sell everything on the marketplace in 3 weeks periods of time. You go to anywhere else in the country, almost anywhere else in the Bay Area, the single hottest marketplace is single family homes in Santa Clara County. And we'll get into that. Oh, it's right here. We'll get into that right now. So if you jump down to the bottom line here, you have DUI, days of unsold inventory. On the macro level, you have two different numbers here. You have 25.3 and 24.7. What are those two numbers? The top number is based on just the last week. 1 week of data does a lot of fluctuation, so it's hard to really say anything. The second row down is 5 weeks of data, which is my normal indicator. So 24.7 days, everything would sell. But what's the breakdown? Moving over, first we look at single family homes. In both counties, you're at 22.9. So the single family homes are a little bit hotter than the overall marketplace, but then we split down between the two counties. San Mateo County is at 28.2. That's a little slower. And then Santa Clara County is at 20.5. So in Santa Clara County, if you're looking at single family homes, we'd actually sell everything in less than 3 weeks period of time. Based on the last week, we'd sell it in 18 days. These are record low numbers that I just have not seen. Jumping over to our partners in condos and townhouses, it's a much slower marketplace, 31 and 33. Now, when I say it's much slower than 21, 22, but that's still a great marketplace. Anything below 40, in my opinion, is a strong marketplace. 40 to 80 is a balanced marketplace. So these are strong numbers, but they're just not as strong as 20. Now what becomes interesting is if we look at San Mateo County, and this is condos, last week, based on 1 week of data, it was all the way down at 59 days. That's getting up there in the middle of the marketplace. That's starting to be a balanced marketplace. The 5-week average is 40, which is still a fairly strong market. What the heck happened? That's right up here, and this is one side of the equation. Offers accepted a week ago in the 1 week period of time. So basically, from the 6th of February until the 13th of February, San Mateo County condo townhouses sold 41 units. We should be selling more units, but instead this last week, from the 13th through the 19th, they only sold 26 single condo townhouses. So it's the demand that dropped up. Now, the problem is you don't know if that's a 1 week fluctuation or not. And that's one of the things I'm really picking up is how much this market fluctuates from 1 week to the next. Not that the market conditions change, but just statistical fluctuations. So I'm thinking about abandoning a lot of my 1 week analysis and going for something like a 3 week analysis. And I'm hesitant, but I think I need to do that because there's a big difference between 40 days of unsold inventory and 59. And if that's just a statistical fluctuation, you can't be making decisions based on the 59. If you go over to Santa Clara County, it's a bigger marketplace and you're at 28 days. So 28 is faster than San Mateo County, and that's true in both types of property, and that's unusual. Normally, San Mateo County has been the faster marketplace. However, since shelter in place, Santa Clara County has been the faster marketplace. Why is that? My best explanation is people are willing to commute a little bit further to get a little bit more house for their money because their housing needs have changed. What's the rest of this? This is looking at the supply side at the top, active listings. There's a lot of numbers here, and I'm putting it up here just to sort of give you an idea what's going on. The first two numbers are supposed to be the same. It's two different mechanisms to access the same database. But I'm sorry, 1618 and 1655 are not the same numbers. They're supposed to represent the same available listings. I want to dive into the details, not during the meeting, obviously, and find out what listings and how many listings are there different. Because if I access one MLS and say what's on the market in Santa Clara County, I should get the same answer as if I get on the other MLS and see what's on the marketplace. And clearly that is not happening. So the bold numbers at the top are all across the board lower and was the preferred MLS vendor that I was planning on using. The one in the bottom are all higher, and the one that I've been using. So I'm doing it by hand this week for what I've done to use the statistical consistent data. I need to understand why there's a difference. There shouldn't be. These are 1 week and 5 week data points. So these are all my preferred vendor long-term versus my preferred vendor going forward. And the big problem is I can't use my big preferred vendor in the past because I can't automate the data gathering. Now let's put it back into graphs where you can see and understand what's happening a little bit. Again, what we're looking at is the two components. We're looking at supply and demand. The yellow line that's horizontal, that is the median. And so if you compare the median to the median, you're always going to be on at 100%. And so this yellow line represents where you'd expect the other three lines to be if we were having a normal year. How do we have three lines if we're only looking at supply and demand? Well, on the supply side, we're looking at the blue line, the total available inventory. How high is the reservoir? What's on the marketplace? As well as the gray line, and that's how much water is coming into the reservoir in the given week. And so if you look at the gray line for just a second, you can see 2 weeks ago, there was a huge dip in incoming inventory. That was probably related to a holiday, but again, they're all above 100%. And in rough numbers, I would say we're probably at somewhere about 135% of the inventory coming on the market on a weekly basis or for what we'd expect. Total available is the blue, we're actually at 140%. So we have more available inventory than we have coming on the marketplace, which tends to suggest you have stuff that's been on the marketplace for a long time and just sitting. And again, if you had 140% of normal inventory, 40% more inventory than you normally do, you'd expect the market to be slowing down. Why isn't the market slowing down? You got to look at the offers accepted, and that's this red line. And basically, you can see the red line is right with the blue line. So whatever comes on the market, the demand is there to buy it up. So even though I have argued in the past that I don't think the Valley has been limited by on inventory on the number of transactions that are started by lack of inventory, this slide would actually tend to suggest it has been. The reason I historically say inventory hasn't restricted transactions is we've had lower DUI with more transactions. But this is saying whatever comes on the market, the buyers are willing to buy up. So two different arguments coming from the same person. Which is right? I don't know. What do I expect to go forward? Well, frankly, you'd expect it to be at the 100% level, but seeing how it's been higher over here, it's staying up higher, understanding that shelter in place has caused people to have a shift in their needs, I would expect this to stay probably somewhere around 130%. So we've basically shifted the yellow line from 100% up to 130%. That's what I'm expecting. There's one major red herring that's coming up at us, and it's essentially here now, and that's April 1st. And that's going to be our people over 55 going to take advantage that they can move their property tax basis to any other home anywhere in the county, outside the county. I'm inclined to almost say it's not going to have a huge impact. It should. Time will tell. The reason I'm saying that it should start impacting us now is if you look at April 1st for closing, and if you have a 30-day close of escrow, you're back to March 1st. And if you're looking at a 2-week marketing period, you're looking at right now. So what we should be seeing is increased inventory coming on the marketplace. Yes, there's increased inventory, but there was increased inventory over here before people were worried about the new tax advantages. And I think that's just the unsettledness in the home, that home no longer meets people's needs. So recapping all that, my gut level prediction is we're going to be at about 135% going forward. Time will tell. Now let's look at it just one component at a time. This is total active inventory. This is what's in the available for the buyers to buy. And you can see the huge drop down here. That's because this is current year data. That's last year's data. So that's just the shift between one year and the next. And last year we basically had normal inventory, except towards the end here, we pulled away and started having above average inventory. We're continuing to have above average inventory, maybe a little bit a higher percentage now than at the end of last year, which is an interesting thing. Basically, I'd expect 1,250 listings. What did we have? We had about 1,650. So we had almost 33% more inventory than you would expect. This is looking at the number of new listings. You can see right off the bat, it's jumping all over the place. And the reason it's jumping all over the place is it's 1 week data. What happens in any given week can change quite a bit. But you can see the blue line is above the gold line. It has been all last year. It's shocking on how similar the pattern is, but that's Thanksgiving, that's Christmas. So even though the impacts should have been less because of shelter in place, they were essentially almost as great by the time we got to here. Earlier, the impacts that I noticed weren't as much, but on a percentage basis, you can really see it. This is probably Labor Day, which basically was non-existent. What would I expect going forward? I'd expect the number of new listings to come on the marketplace to basically follow the gold trend and just basically, a little bit above, probably 35% above. And again, time will tell. Now we look at the number of new offers. It's the exact same story. Even though it's not labeled, to the left of the first purple line is 2021, to the right is 2020, and the 5-year standard. I do not expect this dip down. This was shelter in place. The reason this came in before shelter in place, this dip down, is I used a 5-week average. So basically, if I go to week number 11 and I'm going back in time 5 weeks, I'm going back to week 7. So right here at week 7, it started dropping down. Why would offers drop down? Well, if an offer was in escrow, the buyer backed out. When I'm looking at it a week and 2 weeks after shelter in place, it's no longer there as a current offer. And so the number of offers that were in this period of time dropped. That's why this sharp drop started before the actual shelter in place. What do I expect? I don't expect any dip whatsoever. I expect it just to keep coming up and following about 30%, 35% above where the yellow line is, where the standard is. Now we're looking at the number of closings. Really nothing different here. It's the same story as the number of new offers. It's just delayed by the duration of escrow because you don't have a closing until escrow closes. It does seem to me, if I just look at these numbers, that this is not quite the same percentage up, which would tend to say we're having a little higher transaction failure ratio, which really doesn't sound accurate to me. So if I did the math, the percentages here probably would work out the same, even though visually they don't look that way. These next several slides are really irrelevant. This is simply the number of expired listings. It's irrelevant because you're talking somewhere down in the 10s and 20 range, which is insignificant. Why were the spikes so high last year? I think those were listings that were taken off the market, reaching their expiration date. I think once we get past week number 10, when shelter in place was announced, we'll see a lot more performance closer to the gold line. I would expect these high peaks to come out. Why would we have a high peak now? Basically, what it's saying is that people put the listing on the market in the month of January. They took a year listing, so the listing expired at the end of January. We'll have a little bit of that in February, but by March, we were in a different marketplace and that kind of stuff wasn't happening. So I expect these huge spike ups at the end of every month to go away, and I expect to be back down in the noise level. Canceled listings, these are listings that the seller pulls out of before the term of the listing agreement expires. And it does a little surprise me in a hot marketplace that your blue line, your current data, is consistently above the gold. My best explanation is some sellers are coming on the market. They don't want people coming through after they see what they're going through, and more people are canceling their listings. We also have, and we'll get into that probably in a second, a huge dichotomy in the marketplace. You have some properties that have been on the market for a year and sitting, and the others that are coming on and selling as soon as the seller would accept an offer, which is by far the biggest majority. This is withdrawn listings. There is no yellow line. The reason there's no yellow line is if you withdraw a listing, once it hits the expiration date, it becomes an expired listing. So these all go to zero and is really irrelevant. Now we look at pressure the buyers are seeing. This is the frequency of overbidding. How common is overbidding? And you can see we're basically up here in the low 60s, 63%. We're down a little bit from last week, but not a big deal. And again, you can see this huge fluctuation because I'm only looking at 1 week of data. I'm looking at the whole macro market, which means like San Mateo County, all of a sudden there was a whole huge drop in condo market prices. If the condo market market isn't as hot, you'd expect the frequency of overbidding to go up. So 1 week data has a lot of fluctuation, and you can see it in this data over here. It's almost going up and down like a sawtooth. That's why I'm thinking of going with a 3-week data point. So frequency is how common is the overbidding. Next, we look at the magnitude of overbidding. Magnitude is how much are buyers. Oh, and I should go back. This red line here, it should come all the way down to 50%. So, right now we're well into a red hot seller's marketplace, even though it doesn't show. And this is in PowerPoint, so I can't drop down my Excel. So I'm pointing that out last week. I meant to update the slide and I didn't. This slide is accurate. Basically, I use 101.5% and above to be in a seller's marketplace. So you're in a strong seller's marketplace with the magnitude of overbidding. This gives you some indication of how much pressure the buyers are feeling to overbid. I'd expect this to be way outperforming last year's number. The reason for that is we're getting further past the shelter in place insult, the insult to the marketplace, whether it be shelter in place, 9/11, whatever, a true recession like 2007, whatever the impact is, buyers get more conservative with their overbidding. So that number gets a lot lower. Here is the overbidding on a weekly basis. So the concept is the red line is the current week, and this is simply looking at the sale price to list price distribution. So basically what it's saying is 65% of the sellers got more than their asking price. Almost 75, call it 73% of the sellers got their asking price or more. Only this 27% over here got less. So as the line moves from week to week, and if the line goes this week, that way, diagonally up to the right, that is an improving marketplace. So this dotted line here is the best month we ever had, which was April 2018. This is the worst month we ever had, which was December of 2021, the year of 9/11. And then within all this, the solid lines are the most recent data points. The dashed lines are the next most recent, and the dotted are the oldest. And I only go back to October 9th. So you can see the market is starting to really outperform what we were doing in the October timeframe. It is a little interesting that here is January 2nd. So granted, it's only 1 week, it's a holiday, but it was a underperforming holiday, and this is for closing. So this is really the offers that were sort of accepted Thanksgiving week. Those buyers felt they didn't have to overbid as much. But now for the offers that closed this week in February 20th, which are basically offers that were done probably in mid-January, those buyers are feeling they really have to overbid. What would I expect? I'd expect this red line to just go climbing up this way. How high up will it climb is anybody's guess. I don't think we'll ever get back to a 2017-18 marketplace, but we just might do it. It's time will tell. Same data, just clearer to see. The solid lines are the more recent. The red is the current week. Dashed are the more older, and the dotted are the oldest. So the concept is the same. And I think with that, I'm just going to do a little recap. This is January's data. I tried to race through and get February's data on here, and I got down to sale price, but I was out of time, so I just don't have that. I will have that for next month. I also hope to bring back some more of my datas, but I will open it up for questions since I went through it so quickly. But that is all that I have to present. Any comments from anybody that's listening?
So you're going to use the 3 weeks instead of 1 week?
I'm still having
But
that debate. I have
yeah,
that debate with myself.
but then see the 3 weeks and 5 weeks is only, it's so close.
It is so close, but you know, the issue, does 1 week tell you anything? And actually it's interesting you bring up the 5 week issue. Right now, offers and closings are both 5 weeks, and that consistency is very nice, and I like it.
Yeah.
Unfortunately, on offers, and this might be my lack of knowledge, but right now my offers, I may have to go to 4 weeks of data. And that may be something that I'm forced to do based on how I'm able to access the data. The problem I'm having is my preferred MLS access does not let me sort by closed transactions by sale date. Once the transaction is closed, the only date I can use is close date. And so if I go past 4 weeks on data, I start losing a lot of my offers because they're closed. And so now if I have to do 4 weeks of data, I may go with 4 weeks and 1 week of data. And that's why I have these debates with myself all the time. They're pretty funny to watch.
Yeah. Okay, I see.
Because my underlying goal in all this is to try to have the data be meaningful. I don't want to have data for having data's sake. So if 1 week's worth of data doesn't mean anything, there's no reason to have it. Now, maybe what I end up doing is a hybrid where I have 1 week of data and 4 weeks of data and forget about 3 weeks of data. And that's sort of where my current mindset might be going, because then you can say, hey, the data this week really slowed down. It's something I should look at. Do I need to look at 2 week data, 3 week data, and my normal 4 week data, or do I just wait 1 more week? Because one of the huge advantages is I firmly believe when I first started doing this way back in 97, this data gave you about 90 days of lead time, what would that be? The 13 weeks of lead time to go on what's happening with the marketplace. From when the data changed to when the general public perceived the change was about 13 weeks, a full quarter. And that was huge. You could actually advise clients could take advantage of the changing marketplace. Because I'm sharing the market, the data, that time frame has been cut down probably to 7 or 8 weeks. So, I've lost almost a whole month by sharing the data, but you can still gain something. So you don't need to react immediately on the changing of the marketplace, but you need to be prepared for it. And this is something I've told clients before, is if you're thinking about getting ready to put your house on the market in April, you should be ready in January, just in case the market changes, so that you can put that house on the market immediately and hopefully close the first offer that comes in before the consumer recognizes the marketplace has changed.
Yeah, that will be that. It is a good strategy. Yeah, I think that's the reason that you're continuing doing this. It's very critical.
I do it because I want to know for myself and for my clients. Sharing it, gets me to keep the data updated. And, if I have it, why not share it? But the number of people that take advantage of it are pretty slim. There's 4 people online right now, and there's usually only about on a good week, there's only about 35 views of my archive data, and on a poor week, it's down around 15. So at times I wonder, is it worth all the time, energy, and effort? But it's something I do, and I may change. I do other things as well. And it's off topic, but I do elder advocacy, specifically conservatorship. And right now it looks like I got 3 bills introduced this year at the state level, which is pretty incredible when you think about it. Up to now, I've had 2 bills introduced, but only 1 bill per year has gone forward. But as an individual, to be able to do that and introduce bills that are changing things is pretty phenomenal, and it takes a fair amount of effort. Let's get back to real estate, though. Any other questions from anybody else, or do you have any more questions, Lily?
No, I don't.
Anybody else? I'm not seeing anyone else unmute them. So I will try to work and settle some of these arguments with myself and get back to a little more robust presentation next week.
Oh, okay. Yeah, you're good. Thank you.
You're welcome. Take care. Bye, everybody.
Sure.
Thank you.
Bye.
Thank you.
You're welcome.